Excellent. Welcome, everybody. I'm Xavier Martin, Deputy Director at Digital Frontiers, and today I will be introducing this session. This morning or afternoon, depending on where you are, I have the immense pleasure of introducing Anatol Monid. He's a former supervisor and currently Senior Director at the Toronto Centre, where he works in terms of expanding financial inclusion. So we want to give everybody the opportunity to interact with Anatol and asking questions or sharing your thoughts on the topic. So you can do that anytime using the chat live function that you will find on the right bottom corner of your screen. Russell will address your questions. We'll address your question at the end of the presentation. Today, Anatol is going to talk about regulation and how regulators can help in terms of building digital financial inclusion and promoting also a more good environment for that. So without further ado, let me pass it over to Anatol for his presentation, and then we can have a chat about it. Welcome, Anatol, and thank you so much for being here today.
Greetings, Xavier, and to all the participants who are attending. It's a pleasure to be here to talk about the role of policy and regulation that must exist in order to support financial inclusion. So let me share my screen. I put together a small presentation to help us. And Xavier, you can see that?
Yes, we can see it. You can see it very well. Thank you, Anatol.
Okay, let's see if we can get through there. So new technologies and digital provisions for payments and other financial services is rapidly changing the landscape. Digital financial services are becoming the leading driver of financial inclusion for the unbanked. What makes this possible is not only innovation in products and technology, but also regulation. A complex set of rules underlying the ability of ordinary people to access financial services conveniently and safely through a few simple steps at the point of service, usually a mobile phone or a shop. For this to happen, legislators, central bankers, regulators, and supervisors must ensure that regulations in such areas, banking, payments, consumer protection, anti-money laundering, come together to form an enabling framework. We could talk for days on this topic, on each of these topics, but we only have a short time to cover the laying of the groundwork, the setting the stage, the building enablers, as well as looking at risks. So we'll briefly also touch on a couple of examples. There's a high degree of consistency and commonality across the models that have been developed to promote digital financial services and financial inclusion. In the case of the UNCDF has described 4 development stages for a digital financial services marketplace. The first is the inception stage. The country does not have the foundational digital rails in place. By digital rails, we mean policy and regulation, ID infrastructure, phone ownership, agent networks, and digital financial services to allow the development of digital financial services beyond voice and internet, or digital services beyond voice and internet. The startup stage, the country has the relevant foundational digital rails, as we just mentioned, in place for citizens to access and use some of the basic digital services, mainly in the payment and finance sector. Several providers are offering mass digital financial services reaching the unbanked, but innovation is still in its infancy. The expansion stage is with digital rails in place and digital payment systems becoming widely available and actively used. The innovation ecosystem has started to develop with various partnerships and services in the range of domains for finance, agriculture, e-commerce, and numerous players like phone providers, fintechs, startups, entrepreneurs, and incubators are developing in the marketplace. In the final stage, consolidation, citizens benefit from a large offering of digital services and in various domains that are accessible and easy to use. They enjoy the choice of providers. In this stage, providers have moved beyond a focus on access and usage and are now competing to keep their clients and focusing on adding value. During this stage, clients have access and harvest the benefits of a digital economy in various aspects of their daily lives. The World Bank has developed guidance for country support programs that serve to prepare a financial ecosystem for better and more lasting financial inclusion. They cite 4 specific components that aid in the establishment and development of better financial inclusion. The National Financial Inclusion Strategy, including monitoring and evaluation, is important. It should not be seen, the financial strategy should not be seen as just another bureaucratic milestone, but rather an important step in achieving financial inclusion. According to the World Bank, recent data shows that countries which have adopted financial strategies achieve much higher levels of financial inclusion than those that don't have a strategy. Financial infrastructures are important, such as payment and credit reporting systems. Having a diverse financial services marketplace for individuals and enterprise needs are important, and also financial consumer protection and financial capability. You can see that there's a correlation between the UNCDF development stages and what we've just described in the World Bank's necessary components to ensure more successful financial inclusion. And you'll see this trend continue. Consumers need a set of competencies to engage in digital financial services transactions, to make informed choices, to identify and report suspicious products and services or service providers, to increase their own welfare, efficiently enforce their rights, and to have confidence and trust in the financial system, particularly on a digital basis. So in this case, the consultative group to assist the poor, CGAP, has identified key enablers. Financial inclusion needs a legal basis for a range of providers to serve the unbanked and underbanked, using a variety of delivery channels that may include bank and non-bank providers, as well as network agents. Secondly, they cite that regulations supply the mechanism for effectively dealing with the risks that the digital financial system may pose to consumers and the financial system or ecosystem. And finally, the way in which DFS-specific rules are developed and applied can and should accommodate innovation while promoting safety. The ideal is to balance a proportionate regulatory system that enables and protects, but avoids undue compliance costs on often low margin DFS providers. CGAP goes on to look at specific enablers, where we've talked about the general framework in this previous slide. There is little doubt that regulation is a general enabler of financial services. Let's just look at these 4 specific enablers. They themselves are not sufficient to allow a digital financial services marketplace to flourish, but they are our mainstays. Non-bank e-money issuance. A basic requirement is to create a specialized licensing window for non-bank DFS providers to issue e-money accounts. You know, their prepaid accounts or stored value accounts are another term for these, without being subject to a full range of prudential rules which are applicable to commercial banks, and without being permitted to intermediate funds. The use of agents, DFS providers, both bank and non-bank, are permitted to use third-party agents such as retail shops and to provide customers access to their services. The need for risk-based consumer or customer due diligence. An appropriate money laundering framework is adopted using a simple regime for low-risk transactions. These may be opening accounts or using e-money accounts and conducting over-the-counter transactions with the DFS provider. These are usually in lower value amounts. And finally, consumer protection rules are tailored for the full range of digital financial service providers and products and provide the necessary margin of safety and confidence for the marketplace. Xavier, our audience are supervisors and regulators primarily, and they're thinking about the risks specifically introduced by digital financial inclusion and and how they're tied back to an enabling marketplace. Let's just look at 5 potential risks. New providers and new business models involve partnerships with banks and non-banks. This will increase interconnectivity, which creates risks for the entire financial system. So supervisors need to guard against improper transfer of risk between providers and banks. The use of new or more intensive technology, the rapid development and use, can supervisors keep up with the way digital business is being conducted, and do they understand the technology, in particular, the greater risk of artificial intelligence being engaged is a growing risk. The extensive use of agents, the principal means by which consumers conduct their business in a digital financial services is cash in, cash out transaction. The use of agents creates an outsourcing risk for regulated entities. New products and services and their bundling. There may be unfamiliar or untested products being used in the marketplace. Do we know the consequences of all the products and transaction types that are being used? And finally, who are the financially excluded and underserved customers in your jurisdiction? Are they being served with suitable products and services? And how do regulators and supervisors know that the benefits that come with digital financial services are being accrued by their citizens? Let's turn to an example of digital financial services in the marketplace. I picked one example in Africa and one in Asia. So in Mozambique, when they set out to provide and introduce mobile phone operators a few years ago, many doubted their relevance in such an impoverished country. But its use has expanded rapidly and included in many rural areas now. This makes financial services available to rural citizens and can help spark small businesses, improve the ability of households to make savings and invest in durable assets and education, and transfer and receive money from relatives. The Mozambique strategy had 3 pillars: access and use of financial services, strengthening the financial infrastructure, and consumer protection, as well as financial education. Its successful implementation depends on the ability of state institutions to ensure that conducive interinstitutional coordination, adequate macroeconomic and legal environments, the provision of a basic infrastructure, and a commitment of the private financial sector operators. The strategy builds on collaboration that was existing in the Mozambique marketplace amongst various stakeholders. And this has resulted in a number of reforms, including but not limited to the approval of a new regime for agent banking systems. And so when I talk about these, think about the enablers and the conditions that we've talked about earlier. So the approval of a new regime for agent banking activities, the establishment of a single network, national network that unifies electronic payment systems and allows for a reduction in the cost of interbank transactions, and the development of new rules for banks to open their branches, taking into account geographic proportionality. So Mozambique is coming to the end of their of this national inclusion strategy, and hopefully we'll see how they've been successful in achieving their internal target when they do their evaluation. In Vietnam, the strategy was aimed to ensure that individuals and enterprises, particularly low-income and vulnerable people, micro, small, medium-sized enterprises, have access to basic financial services and products, such as payment, money transfer, savings, credit, and insurance in a convenient and an important component is an affordable way. Not every jurisdiction can dictate price, but certainly some of the effects of the jurisdiction can, in those that can't control cost, can be in building infrastructures and means, as in Mozambique, where the switch, the single network switch, reduced the cost of interbanking transactions. So in the targets in Vietnam were to, and these are for 2025, at least 50% of communities have offices that provide services. At least 25 to 30% of adults have savings accounts. That non-cash transactions will increase by about 25% per year, and that 250,000 micro, small, and medium-sized enterprises can access bank loans. So to achieve these targets, the Vietnam strategy has been to provide a number of solutions, streamlining the legal, and again, this is where we look and say, you know, what do we talk about the enablers and the framework? The legal framework has been adjusted to ease the implementation of financial inclusion. They've diversifying financial services providers and supporting channels to ensure greater coverage. They've upgraded the financial infrastructures, and there's a reduction in transaction fees. So all those go to improving the digital financial inclusion in their countries, and we wish them luck in their delivery. Mozambique coming to the end, but Vietnam just starting out. Finally, I would be remiss if I didn't bring climate change and digital financial services together. And many of you are wondering, what? Well, let's just put the context here. The United Nations High Commissioner for Refugees has indicated that over 100 million refugees and displaced persons worldwide are affected by climate change. And one of the greatest climate change is one of the greatest threats to people. Every year, more than 20 million people leave their homes and move to other areas in their country because of climate issues. We know that refugees are impacted by or have reduced financial inclusion because in many cases they need to leave quickly. Their documents and access to financial services may be destroyed. Infrastructures are damaged. So although climate change reduces rural residents' consumption and increases their risk, digital financial inclusion significantly mitigates the negative effects. Governments can make policies to increase the usage of digital financial inclusion in rural areas by promoting the construction of sustainable and resilient digital financial inclusion facilities. Governments should strive to deepen the impact of digital financial inclusion on rural household income and consumption to further improve their ability to resist climate risks. So that's the end of my formal presentation. I hope that for the participants, this has given them a very quick overview of the frameworks needed to advance financial inclusion from a regulatory and policy perspective. I've added some references here to the material that I've presented, so you can learn more about these important concepts for yourselves. I hope the audience has enjoyed this, and we're ready for some questions, Xavier.
Thank you so much, Anatol, for this insightful presentation. Definitely a lot of food for thought there. So we really appreciate that you shared your wisdom with with us. In your presentation, when you were talking about enablers, you were mentioning about this balance between the need of protecting customers, but at the same time promoting low-cost solutions to be sure that it's affordable for providers to still make a business case for this type of interventions. So is there a key area to begin at, or a key policy and regulation that need to be in place, and how do you balance this balance between risk and innovation, no? And controlling the risk, but at the same time be sure that you promote innovation and new solutions?
Yeah, so this is always the challenge, and of course it's a challenge, you know, providing not just for financial inclusion and digital financial services, but in general, regulators and supervisors, central bankers and governments always need to address this in regards to financial services. We want ease of access, high level of usage, but we want protection as well. So I think that in the work that we've seen, the key step to enabling is the customer due diligence. And this is to look at proportionality in terms of KYC, know your customer, having electronic KYC. We're seeing many more jurisdictions adopting an electronic know your customer accessibility, and that opens the door to basic services and allowing for mobile money operators to engage the simple transactions. That's opening the door is the first key enabler, and I think if we go back and look at those digital rails and the enablers that CGAP has well identified in their work, that's where people will have greater access and usage.
Thank you, Anatol.
But on a protected basis.
Very important. And Anatol, you have a large experience as a supervisor, and you have worked in many countries and being exposed to many environments. From your experience, what will be like an international best practice? I know that that's always a very tricky question. You know, you were mentioning some learnings from what's going on in Vietnam, in Mozambique, but in terms of some potential international best practice in promoting financial inclusion that still allow competition but works for everybody, what you would recommend?
So the most successful jurisdictions that I've seen are those that have a comprehensive national financial inclusion strategy, or a national strategy for financial inclusion, however you want to call it. And I believe that the OECD has listed that as one of its best practices. But clearly, when we go to work in a jurisdiction, that's one of the first documents that we look and assess on how the entire, not only the financial ecosystem, but the country's framework for delivering financial inclusion and what that country wants to achieve. If you don't plan, you're planning to fail. And a national strategy for financial inclusion is a way to plan for success. It's a way to set benchmarks that are measurable. The most recent financial inclusion data is out there for 2022 is just released. People can look at that and benchmark against that. So I would always encourage the use and establishment of a national strategy for financial inclusion. And I'll just make one caveat. That the supervisor needs to be an active, the central bank, the regulator, the financial services regulator or supervisor need to be active participants in the development of that. Because in many jurisdictions, the best practice is not to include them. In other jurisdictions, the banks, the central bank or the supervisor is accountable for the national financial inclusion strategy, but they must have buy-in from many stakeholders within the country. So starting with a strategy that is supported by the government is a really good step.
Thank you so much, Anatol. We are entering the last 5 minutes of our time here. But I want to bring some questions from the audience, and we have one question from Laura. You were mentioning now about national financial inclusion strategies, no? And she's asking, and I will read, how will you advise an authority that has the vision and the ambition to undertake some regulatory reforms for financial inclusion, but has low supervisory capacity to monitor and enforce them? Are there ways to sequence or prioritize?
Well, that's a great question, and somebody who's thinking about the future. So thanks for that question. You know, supervision, supervisors will never have enough resources to accomplish what they need to in their marketplace. This is true in developing jurisdictions. Taking a risk-based approach in your supervision is really the first step to helping you support your national inclusion strategy or the initiatives that the regulator or supervisor is undertaking, so that you can balance, again, you know, against all of the many pressures and demands that are on a supervisor, and finding a way to provide some resources that support that. And you know, supervision is a wonderful thing, because it is like throwing a pebble into the water. It has a ripple effect when you start to do activity. So it's not how much, it's more about what you do, and think about having milestone targets to support your vision. That would be my advice. And thanks for that great question.
Thank you so much, Anatol. We don't have much more time here, but I would like maybe to just to start to wrap up. If you have some ideas on how would you characterize the general role of central banks in developing inclusive financial systems, no? What they can do.
So again, you know, every jurisdiction will have its own legal framework, and that needs to be supported. And because central banks and regulators don't operate in a vacuum, they operate within the jurisdiction that they have been established to serve. And so having the ability to work within the framework and understanding the framework and maximizing the initiatives that you can work with within that legal framework. But as the question came up, it's having the vision to think about improving and working towards financial inclusion that is also an important part. It's not the doing, but it's also having the vision.
Thank you so much, Anatol. Unfortunately, we are just about out of time for this session. And Anatol, it has been a great pleasure to have you with us here today, you know, sharing your insights and on how to better regulate for financial inclusion. We look forward, as always, to having the chance to work with you again soon, and with Toronto Center in the future. And audience, thank you for your attention, for your participation. I'm looking forward to the rest of the summit, and I hope to see you there too. So goodbye, everybody, and thank you again, Anatol.
Thank you, Xavier. Enjoyed it. Goodbye, everybody.